Hello, everyone, and welcome back to another episode of Making Sense of Investing with Court. I am joined with our Director of Investments, Noah Brooks, here at the Good Life headquarters. Noah, welcome back.
Thanks for having us.
Thanks for joining me. So we have a lot to discuss today.
Yeah.
With the biggest event of the year being over.
You mean your bachelorette party?
Yes, that we had a great time. Noah joined Clay and I in Florida for a joint bachelorette party.
That was by far the biggest event of the year.
It was by far the biggest event of the year.
No question about it.
We had a fantastic time in West Palm and just enjoyed the weekend together, and we're having fun. It was nice to let
I have
loose.
not danced that much in 10 years.
Noah's a really great dancer. In addition to being the director of investments, he enjoys the party dance scene. So
I'm not sure if you can call what I do on the dance floor dancing.
There's a lot of bopping up and down. It was fun. We had a blast.
Yeah.
Noah is a talented man and has a lot of skills and is actually going to be marrying Clay and I in January. So January 18th is a big day, and I am honored to have Noah
I'm going to be
the
honored
ceremony.
to be the officiant.
I'm looking forward to it.
Yeah, we're going to have a great
You've
time.
been a big part of my life for almost 11 years, and I've been around since Graham just started walking. So it's a big day, and it's really special.
Yeah, it's
so
going to be good.
Yeah, but the real big event, Noah.
Oh, right. The election.
The election. Okay. Finally, it's over. We have something else to talk about other than the election. The political calls are done. Hopefully, we can get back to just kind of business as usual. There was a lot of volatility leading up to the election, and we knew that going into it. We discussed it on our last episode. We've really been discussing it throughout the year. And whenever there is uncertainty, which an election is an uncertain time, it drives volatility, and this year was no different. So that's all done and over with, and we're going to highlight, the reaction to the election. We're going to highlight kind of where we go from here, positives, negatives, just, nonpartisan way of kind of digesting, where we're at. One thing, Noah and I are blessed. We get a lot of research from a lot of the different investment companies that we work with, in addition to LPL, which does a phenomenal job providing a lot of research to us. Sometimes it can really overflow or overflood our inboxes, but once you start to peel out the pieces of it, there's a lot of good data. But the one thing that really stood out to me this time around was that I got this quote from one of our investment wholesalers that we work with at Voya. And it says, markets are nonpartisan. It's the economy that matters. And don't let politics derail your investment strategy. So I think for us in terms of this episode today, that's where we really want to be focused. Regardless of who you wanted to win or who won or the results of it, we can't let politics derail the investment strategy, because the markets truly are efficient at the end of the day, and they will digest economic data and react accordingly.
You go back to 2016 and certainly 2020, and we had people saying, oh, well, it looks like this person's going to win, so I have to take my money out, or the opposite, I want to put money in because I think this person's going to win. And really those strategies tend not to work when you're investing emotionally, right? So it really is just about the economy, what's happening in the markets, and the markets are not a moral guide of anything. They're a guide on companies' earnings.
Yes,
that's it.
Earnings drive it all.
Yeah.
The markets really do, and companies have a way of really skillfully managing their way through different political environments, resulting in positive returns in both types of administrations. And so I don't think that's going to be any different. So, there's been a lot of things going on. We had the election. It's the earnings season is kind of wrapping up, and our friends at the Fed came out with another rate cut.
Yeah. So starting with the election, I mean, the reaction to the election, and before you even get the reaction of the election, prior to that, that Tuesday, the markets were up tremendously for the year, up well over 20% on the S&P 500. Bond markets not so much, only up maybe 2 or 3%. But then you have the reaction to the election, which is boom, off to the races. S&P 500 up 3% or 3.5% on that Tuesday. The small cap companies up, I think it was 6% on Tuesday, and for a 5-day period, they're up about 9%. And so you look
maybe
back,
due for a little bit of a pullback potentially, but who
they
knows?
could be. We'll
see.
cover some of those items, But looking back on the last 12 months, not necessarily year to date, but on the last 12 months, the S&P 500 is up over 38%, and small companies like the Russell 2000 or the S&P 600 index are up the same amount,
Yeah.
up 38%. And so I say this to everybody that I know is don't bet against America.
No.
Right? It doesn't matter what's happening politically, don't bet against America. It doesn't mean that the market won't ever go down, right? Because it will, there's no question about it. But over the long run, I mean, the American economy has been the place to be.
Yeah. Yeah, it was definitely a strong reaction. I think some of it was due to policy, and a lot of it was due to the fact that we had a clear winner in the end, and things didn't linger. And
Yeah,
I think
that
that was
night.
the fear. That was the fear. Actually, LPL put something out, and we had the best post-election day, I think, in history that came out. So, now here we are, getting back to kind of business as usual. The economy was fairly strong going into the election. But now, we're taking a little bit of a breather. I think the markets are trying to process actual data, inflation data, process the Fed rate cut, and what policies are going to look like with this
The
administration.
Fed rate cut. So the day after the election, the Federal Reserve came out and lowered rates as expected,
Yeah.
another 25 basis points. The second time they cut, the first time they did 50, second time they did another 25. Now we're sitting in a range from 450 to 475 on the overnight lending rate. Certainly it is the cost of money,
Yes.
right, that they're lowering. And the inflation numbers that continue to come out seem pretty good.
Today we received inflation data, and the numbers came out as expected.
Yeah,
So
2.6.
2.6%. But as we've talked in previous episodes, just because inflation is coming down, that's the rate at which prices are increasing is coming down. That's not prices coming down. And I
Yeah.
think, we as advisors are mindful of that. I have, clients are in my office every single day, and it's the same kind of conversations. It's like the price of things is still high. It's just the rate at which the prices are going up is starting to come down a little bit. But people are still feeling it. So,
There's no question about it.
those are things that we're mindful of going into the holiday season. Christmas is around the corner, or whatever holidays you celebrate are around the corner. And I think it's really important that we keep in mind that, it'll be interesting to see, I think, really where consumer spending is at in the retail world after we get through this holiday season, because people are still feeling that pinch in their wallets with everyday prices.
Even though prices or price increases are coming back down to reality, 2.6 today the number was. The prior increases, they're compounded, right? And so prices don't really come down except in some type of recessionary environment.
Yeah, food prices, I think, were up 20% over the last few years, and it's a big number. People's wages didn't go up by that.
Yeah.
So,
although gas is back down.
but gas is back
Right,
down
I saw
again.
$3.20 the other day at my local Wawa. I was like, wow, okay, that's
Yeah.
not bad.
Yeah, so we'll see kind of where things go from there. But as we're talking about earnings, we're sort of getting ahead of ourselves, talking about future earnings coming from holiday spending season. But we're in earnings season right now from the end of the third quarter, and I think we've got some figures here that overall 91% of companies in the S&P 500 have reported actual results from quarter three of 2024 to date, and I think we're in the ballpark of around 75% of these companies have beaten earnings per share expectations.
Yeah,
Above estimates.
the growth overall was about 5.3 in earnings. Taking the aggregate, and that's pretty reasonable.
Yeah,
It's pretty reasonable.
it is. So what do you, what are you looking at going forward with the markets in general, and what decisions as a whole are your analysts within your department making and looking forward to make as we prepare for the end of the year and first quarter of 2025?
I think it comes down to the difference between a Trump trade and a Trump investment.
Yeah.
And what I mean by that is, there was this animal spirits that he won, and obviously we had this big reaction to it. But then it comes down to deciphering which policies that they've espoused are actually positive for the economy and which policies aren't. And so we look at the four things that they've been talking about that are, I don't want to say easy to dissect, but four of the biggest things that they're talking about out there, right? One of them happens to be tariffs. The other one happens to be immigration, deregulation, and then taxes. And so you look at it, and two of those things tend to be positive for the markets. Two of those things may be negative for the markets. But those are the four biggest things that we're looking at. So you take it as it comes. Deregulation. We know it takes too long to build manufacturing facilities here in the United States. And it can take 4 or 5 years to get a plant from the time they buy the property till it's operational. That's just too long.
Yeah.
And so there's a lot of positivity in the manufacturing from a deregulation standpoint. So we like that aspect of it. And then you think about tax cuts. So there's a high likely, it's almost guaranteed at the moment, that they're going to keep the 2017 tax cuts in place. And then they've been talking about lowering corporate rates from where they are down to 15%. And so analysts at Goldman and other dealers have come out and they said, well, we expect, if those happen, we expect corporate profits to be up anywhere between 4 and 6%. Now, that could be a one-time scenario, right? In the quarters after that happens. And then you have some things that may not be great for the economy. You have tariffs. And we know that the former president and the president-elect he's been talking about that for years. They put tariffs on in his first term. If we do a 60 or 80% tariff on China day one, it's probably going to be bad. It will raise prices, which obviously is inflationary. We don't know how long it would raise prices for. Is it going to be a one-time bump? It'll work itself out. And then the other one is immigration, which I think everybody's in maybe on the same page on, in terms of slowing down the southern border. But then you have this idea of, well, are we going to remove 12 or 15 million workers? And that seems to be problematic for the markets. They're talking about removing violent criminals. I'm all for it, right? And there's a few criminals here that are legally here that I think they should take with them personally. But if they're talking about actually removing 12 or 15 million people from the workforce, that seems like it would be inflationary to me.
And I think we saw the 10-year Treasury yield kind of react to that. So along with the market having the best post-election day in history or on the books, we also saw the 10-year Treasury spike. And I think because there could be the risk of some inflationary policy coming our way. So I think we're of the mindset we just kind of have to wait and see what this looks like and how fast things move and get enacted.
It seems to me that they are going to put tariffs on imported goods. But it probably won't be the numbers that they mentioned all at one time. No. It'll be a graduated ease into it. And it does seem to me that they're going to remove violent criminals that are here illegally. And I think I haven't talked to any person, not one, on either side of the aisle that is against that.
Correct.
So it just goes to how much further are they going to go after that? Right. So, and it's time will tell. Yeah. But I think the policies that have been there, that have been espoused by the former president, some of them seem to be pretty positive for the economy, and some of them may not be. Yeah. We're going to have to see what happens.
Yeah. I think when you have deregulation, extended tax advantages, those are good for small cap companies. Overall. So there'll definitely be pockets of the market that I think are really going to benefit.
And we saw those small caps rally dramatically. And for most of our clients, they hold some position in small companies and mid-sized companies. They were the largest outperformer. You mentioned the S&P 500 return, but the Russell 2000 return for the day after the election was the largest since the Russell 2000 was created in, I think it was 1976. Wow. Yeah, it was incredible rally that day.
It is, yeah. So overall, it's been a great year for investors, and I think it kind of goes back to we discussed that the market has been on a kind of a straight upward path really since last October.
Well, 2022, the S&P 500 was down 20%. Yeah. And I'm sure everybody out there, everybody out there, he feels that. But herein lies the rub on that, that because it was down so much, we kind of start a new cycle. And so everybody thinks, oh, well, we've had this massive outperformance after COVID. some people forget 2022. I certainly don't.
I do not. That was probably one of the most
yeah,
difficult, challenging markets to navigate in my 17 or 18-year career. And yeah, I think the point in this is that clients, we really encourage them to stay invested while we were getting creative with CDs and other instruments that were favorable with the interest rate environment that we were in. At the end of the day, we had to stay invested and recover what we were down in those positions. And I think for those, nearly everybody that's been working with me has really stayed the course and allowed us to do what we do. And the accounts have recovered and to pay dividends.
Yeah, no question. Talk about recovery. I mean, everything's at all-time highs.
Yeah.
All the accounts that I look at are all at all-time highs.
Yep.
I mean, it's incredible. And so it just goes back to not investing emotionally.
No, you can't. You can't invest it. You can't invest emotionally. So, Noah, where do you, I guess, see kind of like the rest of the year and getting back to like the beginning of 2025? Are we going to wait and see how aggressive some of these policies are before we make any big changes, or is there anything glaring that we would want clients and friends to kind of think about going into the new year?
One of the things that we're looking at is, we have a slight exposure in some of our portfolios to ESG and to clean energy.
Yep.
And I don't think it's going to get better in the short term for clean energy. And that's not a reflection on my opinion on solar. I mean, I think that's where we're going to be in 50 years from now. Nobody's going to be putting oil into their cars, right? It's all going to be electric. But it's how do we get from here to there? And so in the short term, clean energy probably kind of on the back burner a little bit. It is actually negative for the year. It doesn't necessarily, and this is the weird thing, it doesn't necessarily mean that hydrocarbon energy is going to do great. It just means the clean energy, the PV photovoltaic cells, most of them, like 97% of the production of the world, are made in China, right? And so if there's massive tariffs on those, well, that's going to probably put a little bit of a damper on it. Year end, I mean, we're a month and a half out. Year end, I would say we don't really go up too much from here.
Yeah.
I mean, we're up. The S&P 500 is up 28%.
Yeah.
The 12-month number, if you just go back 12 months, it's 38%.
It's a big number.
I mean, it's a big number. And you do not get those types of 38% returns all the time.
No.
So I think it needs to be digested a little bit. Next year, after the inauguration and we kind of see what policies are put in place, I think there's definitely room for upside.
Yeah.
But I'm going to hedge my bet. I'm going to say if things start getting chaotic, the markets don't like chaos.
No.
They certainly don't.
Yeah.
So
and we as advisors will react accordingly, just as we have, the last several markets that we've, been through. So good.
Yeah.
Feeling positive.
The one thing that we didn't talk about today, and we get calls on it pretty regularly, is President-elect is talking about replacing the SEC chairman, Gary Geisner, and replacing it with somebody who is much more favorable opinion on cryptocurrency, right? So you've seen the cryptocurrencies kind of rally. Here, we're not big buyers of cryptocurrency. Some investors have asked us to buy them for them. We don't do it in the models per se, but people are going to start talking about that again. And there's not, in my opinion, there's not necessarily a use case for Bitcoin. But it doesn't mean that it's not investable. Yeah. Right.
And I think there's other ways to kind of play that crypto trade. I was doing a lot of reading over the weekend, and companies like Coinbase Exchange are poised to do well in these environments because they're the ones that are, the main hosts of.
Yeah, they're selling the picks and shovels.
Yeah.
Right.
They're selling it, so it's there's ways to get involved into crypto without being directly in crypto, and it's. Companies like Coinbase and some of the other exchanges that are out there that could benefit from the crypto trade in general.
Absolutely. There are other things out there that we've been talking about. We've had this big concentration in the top 10 companies, right? The largest of the large. And that didn't happen overnight. You just didn't wake up and all of a sudden NVIDIA is a $3 trillion company, or Apple's or Microsoft is $3 trillion.
Just passed Apple,
well, so they did pass Apple, but they also were added to the Dow Jones.
Okay.
Sherwin-Williams was added on Friday, last Friday, and NVIDIA was added last Friday. And historically, that's not been great. When companies get added to the Dow. Now, Apple was added to the Dow in 2018, I think it was, and has done tremendous. But there's been a lot of companies added to the Dow Jones, and I'm going to say it's like a death wish, but it hasn't worked out.
Yeah.
One in particular was AIG. It was added in February of 2008. The return from when it was added till today is a negative 94%.
Not so good.
Not so good.
Not
So
so good.
we joked the committee, the board that selects which companies to go on there, they are not great stock pickers.
No,
Yeah.
not so good. But we'll see. Maybe the Nvidia trade will work out.
Well, but so
Just-
here's the thing with NVIDIA and artificial intelligence. And people ask us, well, how do we expect earnings to continue to increase? And it really comes down to productivity gains made by artificial intelligence. And, people are using ChatGPT and some of these large language models to ask it questions. But most people that are working today in business that we speak to are not actively utilizing artificial intelligence in their business. No. And that is going to change dramatically over the next 10 years. It's going to go from like 1990, when nobody had a computer on their desk, to 2000, where everybody had a computer on the desk. And the productivity gains that were made in that decade were enormous. And I think that's where we are now. And that's when people ask me, well, how do we expect to get bigger gains in earnings? It's through the benefit of productivity gains through artificial intelligence.
Yeah, and you're seeing it a little bit. Like I have my Facebook page for my practice, Courtnie Nein, Wealth Manager. If you're not following me, follow me on that page. But and I don't know if it's like this on a regular profile page or not, but on the business page, you can type something in and it'll actually say, help me write with AI. And you can put in just a few words. I've been playing around with it, and it will actually pick up what you're trying to say and can create an entire paragraph out of it. So, we're starting to see that with companies like Meta and some of the other ones.
My high school English teacher would be appalled.
I'm sure. I am sure. I can only imagine. I mean, I know like the kids in college now, I have clients that say, their kids have to put their papers through like a AI checker to make sure that they weren't plagiarizing.
Yeah.
So it's we had like Cliff Notes and some of those, but it's a different world.
Different world. Absolutely.
My boys aren't too far away from entering that era of their life.
That's crazy.
It is. Well, that about wraps things up for us today on our segment of Making Sense of Investing with Court. Again, joined by Director of Investments, Noah Brooks. Noah, thank you so much.
Thank you for having me. It's always a pleasure.
Yes, and to all of you, thank you for listening. We very much appreciate your trust and confidence in our team. We work really hard on your behalf to make sure portfolios are prepared and weathered for any storm coming our way. And with that, Noah, I hope you and your family have a wonderful Thanksgiving.
Thank you. Yeah, to everybody out there as well.
Everyone
right?
have a wonderful Thanksgiving and enjoy the time with your friends and your family and all the wonderful things that we all are very blessed with and should be thankful for. Until then, we will see you probably around the holidays. We'll do a special holiday edition.
Yeah.
Wrap up the year. And all right.
Thanks
Take
so
care.
much.
Bye-bye.